I guess the question is, on what timetable will that happen, right? Just like we were talking about, oil prices, the best cure for high oil prices is high oil prices. I mean, is something like that at some point start to happen in the rates market as well?
Thanks, Julie. Absolutely. So if we keep rates right here around, call it 5%, then the U.S. housing market is going to stall or even start declining radically, and we will head into a recession. So I don't see it as being sustainable. But the reason I'm not too concerned about it is that if you look at Europe and you look at a GDP nowcast that's produced by a number of entities, they really already have started a major recession. Their GDP is likely to be down 0.9% just for the quarter. So it's 3.6 annualized. That's almost as bad as a Great Recession. So when investors start to appreciate that, when the actual data comes out, we think that bond yields will come down. But to your point, if they stay this high, we'll have a global recession and the US may even get dragged into it.
And Jay, what are your expectations for the Fed? Perhaps signaling one more hike here in November. Is that what you see coming?
Well, they absolutely should not raise rates because this 100 basis points of increase in the 10-year is a huge tightening in of itself. Now, this Fed is fundamentally flawed in that they just focus on their Phillips curve models, and they also don't adjust PCE for the horrendous shelter calculation the BLS puts out that's delayed by about a year and a half. So really, run rate inflation's at 2%. So they absolutely should not raise rates, but they're entirely capable of it because they really haven't demonstrated any confidence through this cycle.
So what's the scenario then if the Fed does raise rates again? I mean, what are the knock-on effects? I assume you think they'll be mostly negative.
Well, right. If the 10-year keeps going higher and higher, I think there will be more expectations of a slowdown. And again, we think one reason that our Fed may not raise rates is they'll start to figure out that Europe is in a really just a power decline. For instance, retail sales for the Eurozone announced this morning, so I'm surprised people aren't covering it, were down 1.2% for August. So that's a 13% annualized decline. But to your point, if they raise short-term rates and then long rates just keep going higher and higher, then that would be bad. We don't see that happening really because of Europe, but that is really what we've seen over the last 2 months. And that's why the market's been so weak, in addition to it being the fall.
And Jay, you point out rightfully, listen, there's challenges in China and Europe. The U.S. economy has proven much more resilient, remarkably resilient. Do you expect that to continue, Jay? Are you in that soft landing camp?
Well, absolutely. And we've been in that camp for almost 2 years now. And the reason really started out that we do have a very resilient housing sector. We have a shortage of homes, the lowest homes ever for sale. And we think that'll continue. Although if we get mortgage rates over 8%, that sector may start to fail as well. But the other thing is we have all this infrastructure spending. And for the first time, it's truly countercyclical because it's based on investment. And it drops in investment is what drives a recession, not consumer spending just falling off a cliff. It's layoffs that come from the investment sector that hurts consumer spending. So we do think we'll be resilient, but if the Fed just ignores everything that's going on, keeps raising rates, the 10-year goes well above 5, then I would think that we would have like a very mild recession. And then Europe might have a recession that's worse than the great financial crisis because they're just in a power decline right now with no positive elements to their economy. Unlike the US, where you have AI, great housing sector, very low natural gas prices and electricity prices. They don't have any of that in Europe.